Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the creation of an income statement, this time including at the bottom of the income statement the calculation of earnings per share. Get ready, because it's time to take a stance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, and you're not required to do so, but if you have access and would like to, we're in the 218 Make an Income Statement Including Earnings Per Share section under the Practice Problems tab. Closing this back up, we will be constructing another income statement, but now tacking on that added feature, which is going to be the calculation of the earnings per share. In other words, once we get to the bottom line of the income statement, basically net income, we could think about how to break out that income to the owners, because when you're thinking about a corporation, remember it's owned by the people that own the stock. So then we want to consider breaking that income out into, or allocating it to, the units out there that are standardized units of ownership known as the common stock. Now, if we have preferred stock, it'll kind of muddy the waters again. We saw this calculation in the past, but now we can see it as it's related to a full kind of income statement as we go through here, and probably hopefully have a better understanding of what it means. So we're going to go through the income. This is going to be our information up top. We're going to use this information to construct an income statement. We want to get used to the standard format of the income statement, and then think about the earnings per share, the owner's perspective, the stock owner's perspective of that earnings, the bottom line of the income statement. So income statement starts with revenue. So I'm going to go through this a little bit faster, of course, because we've seen this a few times, but revenue top line, revenue is the objective, the revenue is what we're trying to increase, the revenue is why we have expenses. We have expenses in order to generate revenue. We have assets to hope to generate revenue in the future. They're an investment to generate revenue in the future. We have liabilities in order to hopefully generate revenue in the future. So that's kind of where everything is basically focusing in on. So we've got the revenue, that's performance measure. How are we doing over time? We need a time frame to get this. We need a beginning and an end. We need for the year ended, a 12-month time period, or for the month ended, a 31-day or 30-day time period, or so on, in order to calculate revenue. Then we're going to have the cost of goods sold. That will represent the inventory that we sell, if we sell inventory. If we sell things, we will have a cost of goods sold. Represents inventory being consumed. Inventory has been consumed, not necessarily cash at this point in time. The cash has been paid possibly for the inventory, possibly in the prior period, right? And then the inventory is being sold this period. We're consuming then an asset still going down, that asset not cash possibly, but the inventory that we are consuming. And then we're going to have the pit stop along the way to get to the net income at the bottom. That is gross profit. Gross profit is a key number because this relationship between revenue and cost of goods sold is often very significant if our main source of income is the sale of some type of inventory. Then we have selling and admin expenses. Remember that these are basically categories of expenses. Under selling expenses, in other words, we might have other expenses related to them, which could include like the phone for the store, the sales staff for a store that sells whatever it is that we are selling. Anything that's going to be sales related, commission would be part of that as well. The admin would include anything related to the administrative type of stuff, which would be administrative salaries, management salaries, the office of the management, anything going on, phone, telephone, and whatnot, expenses for the administrative offices. Then we're going to break out depreciation separately because we want to focus in on it, especially when we're emphasizing the difference between accrual and cash basis accounting, because depreciation and property, plant, and equipment are one of the biggest examples that show us the distinction of an accrual basis versus a cash basis, why an accrual basis is what we want to use for performance measurements on the income statement, although cash flow is important, and therefore we will have a cash flow statement as well. We want the best of both worlds. We want to track the cash flow, but we don't want the cash flow to distort performance in general. Then we're going to have the operating profit, which will be the gross profit minus the selling and admin minus the depreciation. Operating profit represents how we have done based on our normal type of operations, what our core features are. These are the things that we can compare year over year, because they're going to be things that we normally do. This is where our wheelhouse is in terms of our our best performance. This is what we should be measuring ourselves on. Things that are outside the normal wheelhouse might include things like interest expense. This isn't what we normally do, right? We had an expense related to something because we needed financing. It's outside of the norm. So we're going to break it out outside here or on the bottom. And then we're going to get to our earnings before taxes, which is the operating profit minus the interest expense earnings before taxes. Then we'll calculate the taxes based on those earnings, because as earnings go up, of course, the tax will go up, because the government thinks of themselves as kind of like our partner. They don't do anything, but they take our money, right? So we get a percentage goes out there, right? So as our income goes up, then we'll pay out the tax. They do stuff. I mean, just doesn't, that's not fair. But anyways, then we have the earnings after taxes, which is going to be the earnings before taxes minus the taxes, gives us the earnings after taxes. This is the bottom line. This is the net income. This is what you want to think of as the bottom line of the income statement. However, you might have tacked on to the bottom of the income statement the earnings per share calculation, because if we're a corporation, whatever kind of entity we are, once you've got earnings, you're going to say, okay, now there's earnings. Well, if we're thinking about this from the owner's perspective, then we might want to think, well, what does that mean to me, the owner, right? Or if I'm looking to be an owner, what does that mean to me? Well, if we're a sole proprietorship, then it's pretty straightforward. You're like, that's the earnings. It's all, that's what I did. That's how I did this, because I'm the only owner, a sole proprietorship. If it is a partnership, then you got to think, okay, well, how many partners are here, and what's our profit percentage? Like they own 60 and I own 40, or I own 70 and they own 30 or whatever. And then you got to break out the percentage and think about what it means to you in terms of a partnership. In a corporation, then we break out the ownership into those standardized units, which is nice because they're all standardized, right? Which are the stockholders. So we got to think about how many stocks are out there, and we could break it out into a standardized unit. So you would think you would just take that 368,000 and divide it by the number of stocks, so that people can then have a fixed number, a standard number, kind of like the dollar is a standard number for valuation of things, The common stock would be the fixed number. But if there's preferred stock, then we got to take out the preferred stock dividends, because they get paid first. So preferred stock kind of muddies the water. So you don't want to think of preferred stock as the owners generally, because they don't typically have voting rights. They can't vote. They don't have representation, right? So that means that that they're not typically thought of as the owner, but there has been a commitment to pay them first. So if you were to pay these earnings out, remember that this $368,000 is earnings. So if you say for a year, this is how much they earned, you would say, then you might think, well, they should pay that out in dividends. They should pay that to me. I'm the owner. They should give me that money because they earned that and I would like the money. They don't necessarily need to do that, because they might keep the money in the company, right? They might keep it in the company, and no individual stockholder can force them to pay them the money, because it's going to be based on the decision of management and the board of directors and whatnot. And the only way you can force them to do that is to basically vote for the board of directors and tell them, we want you to pay us dividends, like for the whole thing or something, right? But once they make that decision, if they say, I'm going to pay dividends, they can't just pay dividends to some people. There's no special stockholders that they're going to pay the dividends to, and not others. However, there's a preferred class of stockholders. Again, it's not a better class necessarily, but it's better in the sense that they get paid first. It's worse in the sense that they typically don't have voting rights, right? They don't have, but there's been a commitment to pay out the dividends first. So if management and the board of directors say, okay, we're going to pay dividends, and usually they would pay dividends something less than the 365. We earned 365,000 this year. Let's pay some of that out in dividends. Note, it's possible that they could pay more than 365 out. How? Because they could have earnings from prior years that they didn't pay out in dividends that have been accumulating in retained earnings. This is just what they earned this year. So they could possibly pay more than that, but typically that's not the case, right? Typically they're going to say, okay, we earned 368,000. Do we want to pay some of that in dividends to the shareholders? And you could say, if they do, they have to then pay all the commitments that they've made. They can't just pay, they can't pick and choose just which shareholders they want to pay, and they have to pay the preferred shareholders first. So the preferred shareholders are going to get their dividends first, whatever is owed. Then we can subtract that out. The earnings minus the preferred shareholders gives us the 288. We can take the 288 then and divide by the number of shares that are outstanding. The common shares, which we typically think of as the shares that are actually representing kind of voting ownership, the owner of the company. So then we have the 288,000 divided by the number of shares, 52,000, and that gives us the 553, and we're going to round that to 554. So we're going to round it up to 554 here. That's going to be our earnings per share. So once again, earnings minus what we got to pay to the preferred stockholders gives us what we can allocate to what we think of as general owners, that being the stockholders, divided by the shares, not representing 52,000 owners, but representing 52,000 shares, 52,000 units, kind of like dollars being a unit of value, single units of which people could own multiple units. That means that we have 554 earnings per share. Now, again, that doesn't mean that you're going to get paid 554 if you have a share of the stock. It means that if they were to pay out all the earnings, then you would get 554, but it's quite likely that they'll pay out, if anything, something less than the 554 in order to keep the earnings in the company. And you might say, well, that kind of bugs me. I don't want them to keep, I want my 554 per share, right? But if they keep the money in the company, then hopefully that goes to growth. That means their assets are going up, right? Because they're generating wealth and they're not paying the wealth out. They're keeping it in the company. And hopefully they're doing so that they can generate more revenue in the future. So that means that the value of your stock then that you buy will go up. And you can sell the stock on the stock exchange. So if the value of your stock goes up, then that's a good thing. If they pay it out in dividends, that's also a good thing. So it's a decision as to your investment strategy as well as the strategy of the company as to whether or not they're going to be paying high dividends or they're going to be putting money back into the company. If they're a growing company, if they're a small company that's growing, then typically they're not going to be paying a lot of dividends. They're going to keep that money because they want the capital to grow. And then as they grow, the value of your stock will go up. Or if they're an established company, if they're a very large company that's been around for a long time and they're at the peak of their performance and they're just kind of marching along, they're doing fine, like an AT&T or some kind of like a large type of company, then they might say, hey, we're established, we're not growing anymore, we're doing what we do it well, we're going to take our earnings, we're going to pay out a large dividend, we're going to pay a large portion of our earnings in the form of dividends because we don't need it to take it and grow a large more infrastructure. The infrastructure is already there. Everything's marching along the way it should. We're just going to take those earnings and we're going to give them as a benefit to the stockholders. So there's pros and cons that go with this earnings per share, but hopefully the earnings per share now, you get a better understanding of what that number means in its relation to the income statement and to the earnings after taxes or net income.